Basics of options. Options are contracts called puts and calls. A standard put or call represents 100 shares if trading stock options. Right? If you're trading options on something else like futures, it's going to be a little different. This is the basics. You want to learn the basics, and that's starting with stock. So if you buy one put, it represents 100 shares. You buy one call, it represents 100 shares. And if you sell those, it still represents 100 shares. Okay? Options can be bought and sold at different standardized strikes on an options chain. We're going to talk about that in a second, go over the option chain. All options have an expiration date. Okay, so an option can expire today, it can expire tomorrow, it can expire years from now. But they all have an expiration date. That's why it's called an option, and that's why it's usually a lot cheaper than buying something, because it's always an expiration date to it. Okay? And if you buy a call, you want whatever you're trading, it's called an underlying, or stock, whatever you're trading, you want it to go up. You are what is called bullish. You've probably heard the term bears, bulls and bears for Wall Street and so forth. Well, the bull means you want something to go up, and the bear means you want it to go down. Okay? So if you buy a call, you want it to go up. You are bullish. If you buy a put, you want it to go down. You are bearish. You want it to go down if you buy. Okay? And when you buy something, money comes out of your account. Okay? It's leaving your wallet, it's leaving your purse, it's going to the next guy, right? So when we go to the store and we buy something, we're taking money out of our wallet or purse and it's gone, right? That's the same kind of concept with options. The most you can lose is what you pay for when you're buying an option, okay? If you pay $100 for an option, that's the most you can lose. Put or call. Now, selling is what I primarily teach and talk about. And selling is like being at an insurance company that we were talking about earlier. You receive capital into your account, okay? It's a credit into your account. I like to say it's an asset, right? When you're paying something out, it's a liability. You're getting some money in your account, it's an asset. If you sell a call, you are what? What is this chart telling us? If you sell a call, you are what?
Bearish.
You're bearish, correct. You want it to go down. So it's the opposite of buying a call. When you buy a call, you want it to go up. When you sell a call, you want it to go down. When you sell a put, you are bullish. You want it to go up. Once again, it's the opposite of buying a put. You buy a put, you want it to go down. But when you're selling something, you get money into your account. When you're buying something, money comes out of your account. Okay? And this literally happens in real time. You're trading on a platform like Thinkorswim or TastyWorks that we're going to be looking at tonight. It literally it goes out of your account. Okay? If you're buying, it goes into your account if you are selling. All right, so we're going to jump over to the Thinkorswim platform here. All right, so this is an option chain on the SPX. The SPX is the S&P 500 cash settled index. And cash settled means that at expiration, if something's in the money, we'll talk about that in a second, instead of getting stock or have to give someone stock, it's all done in cash. Okay, you either receive cash in your account or cash comes out of your account. That's how it's settled. Okay, so it's real clean. It's real clean if it's just dealing with cash. Okay, an option chain. This is very important to understand an option chain because this is how you buy and sell options. Okay, on all major option chains, it's calls to the left and puts to the right. And this horizontal orange line here on the TastyWorks platform is what is called at the money. And I have these definitions on this sheet, by the way. Okay? So you can just listen at this point as best you can. This is at the money line, and then this line down the middle, this vertical area, this is where the strikes, these are called strikes. and all strikes are standardized. And standardized means that everyone can buy and sell those strikes. Everyone sees the same strikes. So regardless to where you're at, if you are in the Philippines, India, New York, wherever you're at, if you're trading the SPX cash settled index, you will see these strikes and you'll be able to buy and sell at these strikes. That's what standardized means. Okay? All right. So it's obviously, if something can be standardized, something can be non-standardized, right? You can buy options that are not standardized, that are different strikes that you see here, but that is what is called over the counter, and usually go to a firm to do that. Okay? You go to something like Morgan Stanley or Goldman Sachs or something like that, JP Morgan or whatever, and they can write an option that's not standardized, but they are your counterparty, and you don't want to do that normally. You want to stay within an exchange because the exchange guarantees your counterparty. They have a clearing firm that clears everything. Okay, so you don't have to worry about your counterparty defaulting on you. Right? So if you stay within the exchanges, it's all standardized, it's very, very liquid. When you go off the exchange, it's not liquid. Okay, it's worse than selling a house. Right? If you sell a house, sometimes it takes at least 30 days if you're lucky, right? Unless you get the cash, someone comes and just hands you cash. If not, you have to go through the process, right? So with buying and selling options on the exchange, it's instant. You can get out of something quick, okay? It's liquid, all right? All right, so what you also want to understand on an option chain is that these calls below this at the money line is what is considered in the money, the ITM. And above this at the money line on the call side is what is called out of the money, OTM. And then on the put side below it is the opposite. It's out the money, the OTM. And then above it, once again, the ITM, in the money. So it's important to understand what is out of the money, in the money, and at the money. And it's important because it's about probabilities of what's in the money or out of the money or at the money, and it's about being assigned. I just talked about cash settlement, right? Well, you have to worry about being assigned something, or what is called exercised, if, and I have that word exercise on here, on these definitions once again, if it's in the money, you have a high probability of being exercised at least at expiration. And that's when if you have a put in the money, then you would have to take ownership of those shares. Okay? You have to take ownership of those shares. Some people want to do that. That's a strategy. We can talk about that. But this is why you want to know what's at the money, in the money, and out of the money. And then what we're going to talk about in a second is about probabilities. And that's what probabilities is one of the most fascinating things about options. And you want to know that, right? So, and that's all based on being out of the money. Okay? All right, so moving on, try to be as quick as possible here, but you have to have the foundation here in a little bit to be able to understand what we're going to discuss. On the option chain, you have the open interest, and if you were on the Thinkorswim platform or some other platform like E-Trade or something, it'd be very, very similar, okay? So don't get worried if you're trading on something else. You'll see the same kind of stuff, but you can set it up the same way. Open interest just means how many calls and puts were bought at a strike price. Okay, once again, this area right here is the strikes. So if we're looking at this 3,000 strike, it's how many calls were bought and sold at the 3,000 strike, how many puts and calls were bought at this 3,000 strike. Okay? That is as simple as that. That's what open interest is. The ask and the bid. You can have this on both sides as well. And excuse my drawing here. Ask and the bid is where you buy and sell at. You buy on the ask, you sell on the bid. And let me show you that. So if you're on the TastyWorks platform, the Thinkorswim platform, if you click on the ask, it's going to turn it green. Green means you buy. You're buying. Okay? Green means you're buying. Just like that chart I just showed you. And if we delete this, well, let's just click it here. If I click on the bid, it's going to turn it red. And red means sell. So if you want to sell an option, you click on the bid. If you want to buy an option, you click on the ask. Okay? All right, so the next thing we're going to discuss is delta. And I was just talking about how important delta is. Delta is one of the 4 major option Greeks. And delta is the most important option Greek. It's the most important option Greek because it measures 2 things. It measures your directional risk and it measures your probability of succeeding. Okay, your probability of success. Right? So when I say directional risk, I mean like this. You buy 100 shares of whatever, XYZ, ABC, whatever. And if you buy something, if you buy some shares or something, you want it to do what? You want it to go up, okay? So what is your directional risk with those shares if you buy it? Down. Your directional risk is down. Because if you buy some shares, you are bullish because you want it to go up. So delta measures how much you would lose for every point, up or down, how much you would lose. So if you have 100 shares of whatever, and it goes up 1 point, then you make $100. Because it's 1 point times 100, so you make $100. But your directional risk is to the downside because you're bullish on that thing, on those shares. So if it goes down 1 point, then you lose $100. And delta tells you that. Okay? Delta tells you that. It can tell you that on an individual position, or it can tell you that on your portfolio, your whole portfolio. Okay? And that's what it's called being beta weighted to a certain index or something like that. And most people, even the professionals, beta weight to the S&P 500. And that's what we're looking at here. Yes?
An example of the option chain illustrating the delta?
Yes, I'm going to do that right now. So, that's a great question. So, delta also measures your probability of success, right? So it measures your directional risk, and it measures your probability of success. So if you're at the money, this is at the money here. At the money means where that underlining is trading at. So right now, this SPX is trading at 3005, 3005, okay? So at the money is basically right here, okay? It's right here. And at the money, when something's at the money, and if you buy it there, you have a 50-50 shot of making money. The probabilities at the money are 50-50. Because if you buy 100 shares of Microsoft, and what's the odds on it going up or down? 50-50, right? So the at the money line on an option chain equals 50-50. That delta is 50-50. That means you use a coin flip. You have a 50-50 chance of making money. Now, where it changes, what's really important is that if you buy something at the 50 delta or sell something at the 50 delta, that's at the money, you have a 50-50 chance, right? They're both the same. But what changes is when you do something out of the money, right? That's when we're talking about at the money, in the money, and out of money. Well, out of the money, that's when the probabilities change dramatically, and it favors the seller big time. Okay? And this is why. And I'll show you this delta right now. So delta is over here. And let's say that you want to buy something at the 30 delta. And this is the 30 delta here. Okay, this is the 30 delta. And I'm going to just act like we buy. If we buy, we click on the what? The ask. Correct. So this is the 30 delta. Drop this down. We're buying. So this is it's green. And this line right here is the at the money line. Right? So if you buy something, if it's a 30 delta, it means you have a 30% chance of making money at expiration. You have a 30% chance of making money at expiration. Is 30% good odds? The good odds?
Yeah.
No. Okay. I wouldn't think so. If you buy something at the 30, if you sell something at the 30 delta, you have a 70% chance of making money at expiration, at least 1 cent at expiration. Is 70% good odds?
Yeah, that's not bad.
It's good odds, right? What is Vegas odds on most of their games? The house. What is it?
51-49.
It's at least 51-49 on everything, right? Because they're playing the odds. They know if you go and play, let's say something like blackjack, you might win you might win initially, but if they keep you there at that table, the longer they keep you at that table, the more the odds become in their favor, right? I might flip a coin and land on heads 10 times in a row, right? But if I do it 5,000 times or 1,000 times, I'm going to be closer to that 50-50 because it's a 50-50 probability, right? I'm not a genius because I flipped the coin 10 times and it landed on heads. Okay? That's just the probability. Sometimes it'll happen. It's rare, but it can happen. So why is it that? Why is it's 30% for buying and 70% for selling, and you're at the same strike? Anyone want to make a stab? Why is that?
Good idea.
Okay.
I would say because of the directional risk.
They both have the same directional risk. They both have the same directional risk.
So if you take the money up front, you guarantee that money, offset your loss rights and insurance.
Okay, and I would say you're 75% correct. Because you're taking that premium in, right? So it is a gift card at Starbucks. So that's the reason why you're getting cash in your account, but it's also because of this, and this is the key. If this was green, right? The market, let's just keep it red. Right, so if this was green, the market has to move all the way down here before you win if you're the buyer. Okay? So move all the way down here past your strike, past that 29.60 for you to win if you're the buyer. If you are the seller, the market has to move all the way past your short strike before you lose. Okay? So that's the difference.
In the event you're selling your put.
If you're selling this put, using this as an example, we're talking about the put has a 70% chance of making money. The call, if you buy it, if you buy the put, it's a 30% chance of making money. It's because of this two differences. One has to make a big move before you win. If you buy, it has to make a big move before you win. If you sell, it has to make a big move before you lose. Right? So that's to me, that's one of the fascinating things about options. When you are the seller and you're selling out far out of the money, you can base it on probabilities. You can have this type of philosophy. You can say, instead of being someone that says, Microsoft is going to do this, I just know it's going to do this. You can be someone that says, Microsoft is not going to do this. It's a slight difference, but a big difference, right? Because I can tell you that no one is going to walk in this room that's 7 feet tall. We can stay here all night, and no one's going to walk in this room that's 7 feet tall. Okay? And I'm betting that something that's not probable is not going to happen, right? I'm not betting that. I bet you that someone 7 feet tall is going to come in here, right? That's just a silly bet, right? Don't you think? It can happen. It's not impossible, but it's unlikely that that's going to occur, right? So I tell this story often. I do this in Starbucks. Starbucks have, some of these Starbucks are pretty big, like the one off Westheimer. There's a lot of people come in and out of that Starbucks, right? And I would still bet someone every day that someone 7 feet won't come in at Starbucks, right? But it could happen, right? It could happen, but I'm going to win more than I lose because It's just the probabilities are on my side. And it's the same type of concept with selling options. It's added to money. If I sell something at the 30 delta and I have a 70% chance of winning, does that mean I can't lose?
No.
No. But what happens if it's my first time? I'm new to this, and Brian said I had a 70% chance of making money, and I sold that option at the 30 delta, and it goes against me. I lose, right? It goes past my 30 delta. Is O'Brien wrong? Sorry to talk in third person.
No. It's the odds.
It's just the odds, right? So it's the same thing as flipping a coin once again. You can flip it and you can land 10 times on heads or tails. That doesn't mean it's 100% chance that you're going to land on heads or tails. If you keep doing it, you're going to start landing on the opposite quite a bit. Okay? So I give that example so you won't get discouraged if you lose initially. These probabilities are correct.